When you close your eyes and try to picture a con artist, what do you see? Human nature trains us to look for the desperate. We picture a fast-talking hustler sweating through a cheap suit, pushing penny stocks over a burner phone in a crowded boiler room. We picture someone who needs something from us, someone begging for our attention, someone trying just a little too hard to convince us of a lie. We build our psychological defenses around this stereotype. We tell ourselves that we are too smart, too educated, and too cynical to ever fall for a hustler. But the greatest financial predator in human history didn't chase anyone. He didn't beg for capital. He didn't make cold calls. In fact, he did the exact opposite. He made his victims beg him to take their money. Bernard Lawrence Madoff possessed the ultimate currency on Wall Street: absolute, unquestionable authority. He wasn't a fringe player. He was the establishment. He was a pioneer of electronic trading in the 1970s and 1980s. He had literally served as the chairman of the NASDAQ. He sat on advisory boards for the Securities and Exchange Commission, the very government body designed to catch people like him. He wasn't just operating within the financial system. He was one of the architects who helped build it. And Madoff used that pristine, untouchable reputation to construct a psychological weapon more effective than any sales pitch ever written: the velvet rope. Madoff didn't advertise his investment advisory business. It was strictly invite only. You couldn't just wire him $1 million. You had to know someone who knew someone. You had to be recommended. You had to pass an interview. And if you asked too many questions about how he was generating his returns, he would simply slide your check back across the mahogany desk and threaten to kick you out of the fund. By playing incredibly hard to get, Madoff bypassed the rational, analytical brains of the world's smartest investors. He tapped directly into their ego, their pride, and their deep-seated fear of missing out. Welcome to Case 009. Today, we are opening the massive, multi-decade file on the Madoff illusion. We will investigate how a respected Wall Street titan engineered a $64 billion phantom empire. We will explore the absolute fiction of his trading strategy, the archaic boiler room that printed the lies, the whistleblower who screamed the truth for a decade, and the devastating moment the tide finally went out. To attract billions of dollars from the smartest people on the planet, you cannot simply promise them that they will get rich quick. That sounds like a scam. To trap the elite, you need a story that sounds sophisticated, conservative, and mathematically complex. Madoff's story was a proprietary trading strategy he called the split strike conversion. The pitch went like this. Madoff claimed he was buying a basket of blue-chip stocks, specifically the top companies in the S&P 100. Because he owned these stocks, he would capture the general upward movement of the market. But he knew his wealthy clients were terrified of a market crash. So he told them he was simultaneously using the options market to hedge his bets. He claimed he was buying put options, which act like an insurance policy, protecting his portfolio if the stock prices suddenly collapsed. To pay for this expensive insurance, he claimed he was selling call options, which effectively capped his upside potential if the market rallied too high. In the finance world, this is a real strategy known as a collar. It sacrifices massive, explosive gains in exchange for safety and reduced volatility. It sounded brilliant. It sounded incredibly responsible. And the results were absolutely mesmerizing. While the rest of the market went through the violent, volatile swings of the 1990s and 2000s, Madoff's clients received monthly statements that defied the laws of financial physics. During the dot-com bubble, when tech stocks were minting millionaires overnight, Madoff's fund quietly returned about 10 to 12%. When the dot-com bubble violently burst, wiping out trillions of dollars of wealth and crushing global portfolios, Madoff's fund quietly returned 10 to 12%. Month after month, year after year, in bull markets and bear markets, Madoff's returns marched upward in a perfectly straight, immaculate line. His performance chart didn't look like a volatile stock market. It looked like a savings account on steroids. Financial analysts looked at the returns and called it a miracle. His investors looked at the returns and thought they had found the holy grail of finance. They should have called it an impossibility. Because markets are living, breathing entities. They are inherently volatile. They breathe in and they breathe out. But Bernie Madoff's machine never exhaled. It never took a loss. The reason the split-strike conversion strategy worked flawlessly every single month was terrifyingly simple. The strategy did not exist. There was no algorithm. There was no black box. There was no trading at all. The entire $64 billion empire was an architectural lie, housed inside the iconic Lipstick Building in Midtown Manhattan. To understand the fraud, you have to understand the geography of the building. On the 19th floor, Madoff ran a legitimate, highly successful, and heavily regulated market-making business. This floor was pristine, hyper-modern, and brightly lit. It was filled with sleek, flat-screen computer terminals and hundreds of brilliant young men and women in expensive suits executing thousands of real trades every hour. This was the shiny, heavily audited front door that Madoff showed the world, the SEC, and his clients. But 2 floors down, accessible only to a select few trusted loyalists, was the 17th floor. This was the beating heart of the Ponzi scheme. If an SEC investigator or a curious investor ever managed to step off the elevator onto the 17th floor, the illusion would have shattered instantly. It did not look like the command center of a multi-billion-dollar hedge fund. It looked like a claustrophobic, dirty, archaic boiler room from a forgotten decade. There were no sleek trading terminals connected to the global markets. In fact, the 17th floor didn't execute a single trade on a public exchange for decades. Instead, it was filled with towering stacks of dusty paper, cardboard boxes, and ancient, bulky 1980s IBM computer terminals. The operation was managed by Frank DePascali, a man with a high school education who had been with Madoff since the 1970s. Their job on the 17th floor was not to trade stocks. Their job was to manufacture history. Because Madoff had promised his investors a steady, unyielding return, his clerks had to literally fabricate trade confirmations after the fact. If a client's monthly statement needed to show a 1% gain to keep them happy, DePascali and his clerks would open up the newspaper, look at the historical stock prices from the past few weeks, and handpick the exact trades that would mathematically create that specific 1% return. Once they found the right numbers, they fed them into the archaic computers. Massive, heavy industrial dot matrix printers would aggressively spit out miles of continuous feed paper trade confirmations, complete with fake timestamps and fake transaction numbers. They were literally printing a fictional reality. When new money came in from fresh victims, it wasn't invested in the market. It was simply deposited into a massive single bank account at Chase Manhattan Bank, the infamous account 703. When older investors wanted to cash out, Madoff simply dipped into account 703 and paid them with the new money. It was the purest, most primitive definition of a Ponzi scheme, wrapped in a digital, elite Wall Street facade. But a lie of this magnitude cannot exist in a vacuum. A machine that consumes billions of dollars requires an entire ecosystem of enablers. Madoff didn't build this empire entirely on his own. He outsourced the greed. Enter the feeder funds. These were massive, supposedly sophisticated investment groups with names like Fairfield Greenwich and Tremont. These funds presented themselves as elite money managers doing deep, exhaustive research for their wealthy clients. But in reality, they were just funnels. They took billions of dollars from European aristocrats, international banks, and pension funds, and blindly handed it all over to Bernie Madoff. Why would these supposedly brilliant financial minds hand over billions without checking the math? Because Madoff made them incredibly rich for doing absolutely nothing. The feeder funds charged their clients exorbitant management fees, often taking 1% of the total assets and 20% of the profits, just for the privilege of passing the money through a door to the 17th floor of the Lipstick Building. They didn't want to ask questions. They didn't want to look closely at the dot matrix paper. The fees were too intoxicating. As long as the music kept playing, everyone was happy to look the other way. But in the world of high finance, math is the ultimate truth. You can fool people with a velvet rope, you can fool regulators with your reputation, and you can buy off feeder funds with massive fees. But you cannot fool the math. A lie of this magnitude leaves massive footprints in the data. Enter Harry Markopolos, an eccentric, brilliant, quantitative financial analyst working at a rival firm in Boston. In 1999, his bosses came to him with one of Bernie Madoff's pristine, upward-trending performance charts. They told Markopolos to reverse engineer Madoff's split-strike conversion strategy so they could copy it and offer it to their own clients. Markopolos sat down with the numbers. It took him 5 minutes to suspect it was a fraud. It took him 4 hours to prove it mathematically. Markopolos realized that if Madoff was actually executing the options strategy he claimed on the amount of money he supposedly managed, he would be trading more options contracts than actually existed in the entire Chicago Board Options Exchange. Madoff was claiming to buy more apples than the orchard had ever grown. Furthermore, the perfect straight-line returns were statistically impossible. In the real market, a strategy that limits downside risk also drastically limits upside gains. Madoff's math simply did not exist in this universe. Markopolos knew instantly that he was looking at the largest Ponzi scheme in history. But he wasn't a regulator, he was just a math guy. So he did what any responsible citizen would do. He compiled a massive, detailed, mathematically flawless dossier outlining exactly how the fraud worked, and he handed it directly to the Securities and Exchange Commission in May of 2000. The SEC did nothing. Markopolos didn't give up. He submitted a larger, more detailed report in 2001. And again in 2005 with a memo titled, "The World's Largest Hedge Fund is a Fraud." He practically handed them the blueprint to the crime, begging them to investigate the 17th floor, begging them to simply ask the options exchange if Madoff was actually making the trades. But the watchdogs refused to bite. When SEC investigators finally did visit Madoff, they were completely outmatched. They were junior lawyers and accountants staring down a Wall Street titan. They were intimidated by his aura. When they asked for records, Madoff provided them with mountains of fake dot matrix paper. When they asked for digital records from the clearinghouse that would have instantly proven the fraud, Madoff refused, acting insulted that they would question his integrity. Instead of pushing harder, the SEC backed down. They checked their boxes, politely concluded their investigation, and closed the file. The illusion of authority completely blinded the very people hired to see the truth. Markopolos was left screaming into the void, fearing for his life, while the $64 billion phantom continued to grow. A Ponzi scheme is like a shark. It has to keep moving forward with a constant influx of fresh capital to survive. For decades, Madoff's reputation and his network of greedy feeder funds provided enough new money to keep the machine fed and the redemptions paid. But a Ponzi scheme can only survive in a calm ocean. In the fall of 2008, the global financial system suffered a catastrophic heart attack. The housing market collapsed, Lehman Brothers fell, the stock market went into a terrifying freefall, and the world panicked. Liquidity dried up overnight. Suddenly, Madoff's elite clients weren't looking for steady returns. They were looking for survival. They desperately needed cash to cover their massive, bleeding losses in the real market, to save their businesses, and to pay their debts. The velvet rope was trampled. The exclusivity didn't matter anymore. In late 2008, a tidal wave of redemption requests flooded into the Lipstick Building. Clients demanded $7 billion returned to them immediately. But account 703 at Chase Manhattan Bank only had a few $100 million left. The math had finally caught up. The tide had violently gone out, and Bernie Madoff was found swimming completely naked. There was no secret vault. There was no brilliant trading strategy. There was nothing left but miles of worthless paper. The impossible machine had finally run out of ink. On December 10, 2008, a broken, exhausted Bernie Madoff sat in his penthouse apartment, and confessed the truth to his two sons, Mark and Andrew, who worked on the legitimate 19th floor and claimed no knowledge of the fraud. He told them the entire advisory business was a lie. It was, in his own words, one big Ponzi scheme. The next morning, the FBI knocked on his door. The revelation sent shockwaves through the global economy, destroying lives, wiping out generations of family wealth, and bankrupting charities overnight. $64 billion in paper wealth simply vanished into the ether, revealing a crater of absolute devastation. The Madoff parable is not just a story about a criminal. It is a mirror held up to the financial system. It is a story about the devastating danger of blind trust, the intoxicating power of exclusivity, and the utter failure of the gatekeepers who were supposed to protect us. It is a permanent reminder that in the world of money, authority is an illusion, and math is the only truth. If an investment is too good to be true and the person selling it tells you not to ask questions, you are already the mark. This closes case file 009.